Let's get insights on how Sino-US tensions will play out in the market. Also, the challenges and opportunities with Cheah Cheng Hye, co-chair and co-CIO of Value Partners. This is a boutique company founded in 1993 with about $11 billion in assets under management and annualized returns of almost 14% since inception. Mr. Cheah, good to have you with us. Great timing to be joining us because just hours ago, we had the markets react really violently when Peter Navarro was cited as saying that perhaps the trade deal with China is dead. He has since said that he was misunderstood. Talk to us, put things in perspective for us, this escalating Sino-US tensions, which is one of the biggest geopolitical risks in the market.
Thank you, Haslinda. You're right. The major uncertainty facing equity investors, especially in the China-related markets, is the rising tension. In fact, the crisis, the worst crisis we've seen in something like 30 years in the relationship between China and the United States. Now, I believe that we have to look past this crisis. In fact, logic and necessity makes it a compelling and logical situation where the United States and China will have to become partners and possibly friends and allies again. If I may, I will just go into some details of this. In fact, the US and China together make up roughly 42% of the entire global economy. China is moving to become the world's largest consumer market, and something like 31% of the annual growth in consumer spending in the world comes from one country, China. So a decoupling between China and the United States makes it practically impossible to find solutions to the world's issues and problems. The relationship is just too important. I would argue that China and America, in fact, are complementary powers. They are not competitive powers. It's very different from the situation with the Soviet Union, where both were striving for global domination. China, as far as I can see, is not seeking to export its ideology to the rest of the world and has said many times that it is quite happy to let the US exercise global leadership. So on this basis, I would imagine that after the elections in November, we can build on the phase one trade deal. The trade deal is very much intact. To use Trump's words just a short while ago this morning, the trade deal is fully intact and we can move on to build on it. And I would expect that the future direction of US-China relationship will in fact be moving more towards cooperation out of sheer necessity.
For asset allocators like yourself, Mr. Cheah, what are the most pressing issues?
Yes, as mentioned, we have this Sino-US tension, which is actually the major overhang. And of course, we are looking at how the world recovers from COVID-19. In the case of China, the news has been more positive than I had expected. As recently as early April, I thought China can only look forward to a U-shaped recovery of sorts. But in fact, I was too pessimistic. China is decisively moving into positive growth territory. It's a V-shaped recovery. Overall, China's growth this year should come in at about 2%, I estimate. In fact, just so you know, the world's best performing major market this year, in fact, is China. The Shanghai Composite CSI 300 index already year to date is in positive territory.
So on the one hand, we have geopolitics, the US-China tensions. On the other hand, we have COVID-19. How has COVID-19 impacted your asset management business?
We have been cautious. But in fact, our flagship fund, Value Partners Classic, which is more than $1 billion US in size, already is a break even, more or less break even, maybe like down 1% year to date. We are following China's recovery quite well. Some of our funds, which are mostly invested in Chinese A shares, have recorded gains so far this year of more than 10% already. Yeah. I want to go back briefly to the theme of looking past the current crisis in Sino-American relations to a brighter future. Because I think the world has become very fixated on the idea that the two of them are decoupling, etc. But the figures don't show that. I put a lot of effort into trying to find out what the reality behind the headlines. I think, in summary, basically, politicians do politics, but businessmen follow the money. If you look at the MGM surveys very recently, majority of American businesses in mainland China would like to stay on. They are not thinking of leaving. And majority, according to American Chamber of Commerce, cite improvement in China's environment for doing business. Even the so-called trade balance is not what it seems. If you look only strictly at import-exports, yes, the US has a significant trade deficit with the People's Republic of China. But you include, for example, iPhones, GM cars, Starbucks sold in China and made in China by American companies. So these are not shown up in export numbers. If you include the total relationship, in fact, the deficit suffered by the US in China is not really very large. It's something like 50 billion US, a fraction of the officially announced trade deficit number. So they are truths within truths. In fact, many people don't seem to realize that despite all the negative headlines, today the biggest trading partner of the United States is actually China. It's not Mexico. It's not Canada. The two countries are very much mutually dependent on one another, I would say. China is a leading or principal source of attractively priced consumer products, credit, students, tourists to America, apart from emerging as the fastest growing domestic foreign market for American goods and services. You can't really take away that relationship overnight. So I am looking forward to a situation where these naturally complementary powers, power countries that were in fact allies during the last two world wars of the 20th century, will get back together again and find a degree of accommodation. And look, there's also not only the bilateral relationship, there's the world's problems. Together, China and the US are responsible for something like 43% of global carbon emissions. You need them to work together to really fight climate change. Together, the two countries are responsible for 52% of total global spending on the military. You need them not to fight each other if we are going to have real global security. I think politicians eventually will come to the conclusion.
The reality, Mr. Cheah, right now the reality is there's a lot of tension between uh, the two countries, and Hong Kong is getting caught in the middle of it. Details emerging now about the national security law that will be imposed in Hong Kong, which puts in doubt the one country, two system model. For value partners, for your company, does it remain committed to Hong Kong? How does it view developments in the city?
Look, I want to be frank with you, okay? Uh, I My view is Hong Kong's real problems is not politics. It is the social and economic problems that Hong Kong that's building up in Hong Kong. I've been living in Hong Kong since for quite a long time, and the amount of inequality in Hong Kong created by a system of monopoly capitalism, where only a small number of people are getting richer. Majority of Hong Kong people in the middle class have not seen any real increase in their living standards or purchasing power for at least 20, 30 years. And housing is totally unaffordable for young people. Uh, the system creates vast inequality. It denies access to opportunities for younger people. And the one effort we made a few years ago to introduce a one-man, one-vote system in Hong Kong in 2014, 2015 was defeated in the Legislative Council. So these are underlying problems that are still here, and in my view, are the major contributor. So Hong Kong's problems are more economic and social. And some evidence to back my view simply is that please notice that ever since the announcement of the national securities legislation, the level of protest action, even the efforts to hold a strike by protesters have failed. They are not able to gather the sufficient support from the public to make it happen. On the contrary, the Hong Kong stock market continues to go up. I think today the Hang Seng Index is up another roughly 1% after Mr. Trump came out with a fully intact trade deal statement. The market is looking past the legislation. The market basically seems to feel that the legislation have advantages and disadvantages, but basically it allows Hong Kong to leave behind a very contentious issue, which is the Hong Kong's obligation under one country, two systems to implement some sort of a national security law. Hong Kong had 23 years to do it. It was part of the deal signed between Britain and Beijing on Hong Kong's future. It never managed to happen. So now Beijing is imposing a version of it on Hong Kong after waiting for 23 years for Hong Kong to do it. So, but my point is, I think we have to move on and focus on the very real issues dividing Hong Kong society and denying young Hong Kong people access to economic and social opportunities. That is the real issue.
As an investor, would it make sense for you to shift some of your resources to perhaps Singapore?
Quite frankly, my eyes are more north than south, but they might be peculiar to my firm. So I'm not making a general statement here. Value Partners, as the largest independent brand in Hong Kong, is been actually more by luck than skill. We now have the biggest opportunity of our entire situation. We founded 27 years ago, which is the opening of mainland China to foreign and Hong Kong asset management companies. On 1st April 2020, little notice by the media, China formally opened its doors in financial services to foreign brokers, banks, and asset management companies. And we aim to take full advantage of this great opportunity. This is just emerging as the world's biggest opportunity in a generation for the asset management industry. Huge pool of savings waiting to be managed, growing at double-digit figures per year. Value Partners has been cited by independent consultants as one of the top 10 foreign and Hong Kong companies active in the mainland Chinese market. We set up our office in Shanghai in 2011. So with due respect to Singapore, of course, we also have an office in Singapore, and we think Singapore is emerging as like, it's not emerging, actually is like the Geneva of Asia. You know, it's a lot of private wealth management, etc., private banking, etc. But for us as an asset management company, China is the dream opportunity. I never really thought that we had such a great opportunity, but it's right there in front of us, and we are moving full steam ahead. We are raising money in China, we are manufacturing products in China, and we hope to be among those which will be able to get full access in the fairly near future.
I'll pick up on the China market just slightly in a bit. There is a question here from one participant, and the question is, have central banks created a floor for asset prices? Is there now no argument for a bearish position, you think, Mr. Cheah?
I'm the old style value investing camp. I think the current market in the United States is in the very high risk territory. You don't need to be a genius to figure that out, actually. The PE of an S&P 500 is roughly 23 or 24, as I recall. And while the US economy is doing very badly, I mean, US GDP growth likely this year will be down 6.5%. But valuation of the stock market is an extreme high by any standard. So it's a very big mismatch between high valuation and poor economic performance. Something's got to give. So at some point, I think this kind of financial engineering that we are seeing, this kind of bubble economics that we're seeing that push problems to the future and embark in amazing, huge fiscal and monetary stimulus to keep the party going, it will result in tears. I am pessimistic. Now, I think the world is getting bifurcated because this is not true, though, of the China markets. Say what you like, China was first in, first out, thanks to their very effective control measures for the pandemic. They have been able to achieve a V-shaped recovery without resort to high risk and extreme fiscal and monetary measures. Chinese fiscal and monetary stimulus is modest by global standards, by US standards, and yet they are able to achieve positive economic growth now. And what to me is a quite convincing recovery at a time when their own market as measured by Shanghai Asia Index, is only 13 times. So I think the value investors should be looking seriously at China-related stocks and bonds, while being cautious on US-related stocks. This is not some kind of a political statement. Huh? It's just a statement of fact and a factual observation.
We often
I
talk
would say
about
another point.
bubbles. Where are these bubbles?
The bubble economy in the US was there before COVID-19. I think COVID-19 just brought it into the open as a catalyst. Since the global financial crisis, people like me, by the way, I used to be a reporter in the Asian Wall Street Journal, so I was a financial journalist before, many years ago. So I think the US system increasingly emphasizes financial engineering. It emphasizes kind of like the financial system taking over the real economy and also avoiding the one thing America really needs from Asian eyes. America really needs to undergo a period of building up their savings, practicing austerity, and revamping and overhauling their basic infrastructure. But America, the system is such that it's difficult for any politician to do that without getting voted out of office. Because it's a consumption culture. It's a culture based on creating paper money, paper wealth, and also the system is such that the rich-poor gap is getting very, very serious. Yeah. So there are very underlying problems in America, which can be described as a crisis. And this burst into the open when COVID-19 came. And then you get really like a very unreal feeling. The market keeps going up, a small number of people keeps benefiting, and then you even have people using what amounts to government stimulus checks to buy shares of bankrupt companies like hers. So looking from Asia, it seems quite strange, a bit disturbing, and doesn't appear to me to be very conducive to a soft landing in the years to come. I also want to make one other
Mr.
point
Cheah, we have to
quickly, which is
share. Go ahead.
yeah. Actually, if you look at it closely, America and China are converging in many ways because America, especially with COVID-19, is moving towards what seems like a form of state capitalism, where the Federal Reserve Bank and the federal government and the state governments increasingly intervene in the economy to try to so-called stimulate the economy, hand out checks to people to rescue them from their unemployment, and also create what amounts to a country industrial policy, which in the past they accused China of doing. While China, on the other hand, is moving towards market opening, deregulation, and providing more space for free markets. So it seems that two countries are becoming more alike, not more unalike. It's a very interesting phenomenon. But in the end, I think they really need one another. I think the natural relationship between China and America has to be complementary and not competitive. It doesn't need to be.
On that note, Mr. Cheah Cheng Hye, co-chair and co-CIO of Value Partners, we thank you for your insights today. Thank you very much, Mr. Cheah.